You know that feeling when someone shows up for you just when you need it most? That's what Uber is all about. Not just a ride or dinner at your door. It's how Uber helps you show up for the moments that matter. Because showing up can turn a tough day around or make a good one even better. Whatever it is, big or small, Uber is on the way. So you can be on yours. Uber, on our way.
Reality radio for a really great future. We're talking real money.
Well, look at that. America's closed. Except for the radio. Thank goodness we're open here. Hey, hi. Welcome to Talking Real Money. I'm Don McDonald. Over there is Tom Cock. Thanks so much for joining us on this Saturday or whatever day you hear the podcast. We're here to do something very important, and that is to help you get through this. Not the virus part necessarily, but the money part, which has become a big part of this crisis. It's another crisis.
4, 5, 6. I'm counting all the money I have left after this week in the markets.
I thought you were doing the 20-second hand washing.
$5.63. $5.63.
$5.63.
That's what I have left.
Congratulations.
Yeah, which can almost pay for parking to come here and do the show today. So I got that covered.
No, it didn't. Oh, it did if you parked on the street.
It did, yeah. I didn't park in the building. Yes, I parked on the street.
Well, here's a phone number that you might want to use.
Call right now. Yeah, go ahead.
It's your way to go out in public without going out in public.
Oh, yeah, there you go.
You can call us, and we promise you there has been no COVID-19 transmission over phone lines.
That we know of.
Or radio waves.
Touche.
So here's the number. 855-935-TALK. 855-935-8255. And that is, by the way, free and easy.
So what do you think people want to know about this week? What do you want to know about? What's been happening? Anything happening in the markets or money or anything that's been...
Usually...
Not really.
Usually I don't watch this stuff.
I know you don't.
I don't pay any attention. I've been paying attention every day, but not all day. That's really bad for your health.
Well, especially the way these swings. I mean, wow. 1,000 here, 1,000 there, boom, boom.
Just Friday.
Yeah. Down, up, and then at like 10 minutes to the close, it just went straight up. It's weird.
I know.
It's weird.
It's all very strange.
Yeah, and you shouldn't watch it day to day. You shouldn't certainly watch it during the day. And I don't even think you should be watching it that closely week to week. But we can talk more about that because it just encourages bad behavior. I'll put it that way.
Well, plus, if you pay too much attention, then you get talked to by those idiot talking heads who feel like they have to tell you what's going to happen.
Well, yeah, very good point, by the way. It's not what's happened, it's what people tell you is going to happen next. That's where you should really be nervous because they don't know. The people running the health system don't know how this is all going to play out, right? I mean, let's be honest here. And
we're all guessing.
So, no, you shouldn't handle your money that way.
Oh, and by the way, you probably should use plastic money. Don't handle money.
That's not funny.
On that.
I think I did read Dick's, the hamburger place, is now asking you not to bring cash. Use cards only. They don't want the cash.
Or Apple Pay. You don't even have to touch anything.
My wife is selling pizza today, and she put up some wall or something between her and the pizza. I don't know, some weird thing.
The Great Wall of Pizza.
The Great Pizza, some weird thing.
Or is it the Leaning Wall of Pizza?
Oh, look at you! You're very creative today. Yeah, it's good.
Thank you.
Yeah.
Yeah, here's one of the problems. If you watch or listen to or read most of the financial press, you're going to read things like this that I read this morning. It just was published this morning at Market Watch. Get this. Why you might have to wait 3 years for new highs in the stock market.
I saw the headline, but I didn't read it. What's the rationale? I'd love to know.
But I want to start.
3 years?
I don't even start with the rationale.
Why not 2 years? I'd rather have it be 1 year, frankly.
Here's the thing. I could also say why you might have to wait 3 days.
Yeah, that's the way it's been going.
Or why you might have to wait 3 months. I think it's totally arbitrary.
Yeah, good headline.
And the funny thing is,
there's a rule of 3, right?
I look through it, and he's basing it on an old story by Mark Hulbert as to how long it might take in previous markets to see new highs.
By the way, this is a fascinating topic, and you and I were part of an online class, if you will, that was put together by the academics this week at Dimensional Funds. Now, what did they say? After a 20% drop, do you remember the number? It's fascinating. After a 20% drop, which is what we've had here very quickly.
Right.
Remember the performance, the average annual performance 3 years and 5 years after?
The numbers were huge.
The average annual return for 5 years was 11%, over 11% a year. Does that sound like
previous?
Right. All these
20% drop.
What they would call a bear market, which is. Did you look this up? The Journal today said we're still in it. You said we weren't, but I think we still are. So,
if the Journal, I did. Hold on, I can look it up here.
All right, but we want this to be about you, so you call us about your thoughts, worries, and concerns. If you're worried,
we'll help you get past that. Give us a call, 855-935-TALK, 855-935-8255. And get the straight answer to your financial worries and concerns and anxiety. 855-935-TALK.
Tom and Don are talking real money.
Do you need a little help with your investments? Set up a free, no-obligation appointment with one of our advisors at TalkingRealMoney.com.
For your real life and real future, Tom and Don are talking real money.
And one of the things we forget when we're in the midst of all this is the fact when people look at the stock market, they're thinking, oh, my gosh, that's what I have. That's not what you have. One, you don't have the Dow. Whenever they quote the Dow, you don't own the Dow. You shouldn't own the Dow. It's 30 stocks. When they say the S&P 500, I hope you don't own just the S&P 500. I hope you own a globally diversified portfolio of stocks. And then when you look at the stock market numbers, you probably don't have a portfolio that's 100% stocks unless you're very young.
I think that's the operative. And by the way, those of you who are listening who are under the age of 40, I hope you are mostly in stocks and you're buying them. Every 2 weeks you're putting money into the 401k, and wow, think of all those additional shares you're buying at a lower price. That is great news.
You should be cheering every down day. It's like, oh, my next one goes in on sale.
But let's assume you're in a portfolio of 60% globally diversified stocks, 60%, 40% in bonds, which is kind of the every person, I'm within 10 years of retirement or right there. You've lost 16% of your money. This is not catastrophic.
And what's really interesting, though, Tom, is I look back at October 87, August 89, September of 98, March of 2000, all these big crises. And within 3 years, after every one of those except the dot-com crash, you were up double digits in a 60-40 portfolio.
And we will guarantee within 3 years. We won't guarantee what? No, just guarantee 3 years.
Guarantee something will happen within 3 years.
Yeah, let me give you another number. 2020, the Vanguard 2020 target date fund, right, for people retiring this year. VTWNX, which is a pretty good fund, it's down less than 10. So you're okay. Take a deep breath, take 2 aspirin, call me in the morning. We'll talk about roller coasters and real estate in a couple minutes, too.
Yeah, what was that symbol again? Just because I want to...
VTWNX.
NX. Okay, I'm going to do some checking on that a little later. All right, we have a number that you can call to get your questions answered honestly, succinctly, and based on massive amounts of research and science. 855-935-TALK, 855-935-8255. Give us a call right now. And Phyllis, you're up. Welcome to Talking Real Money.
Hi, Phyllis.
Hello. So I got a question for you.
Yes.
I am a year and a half away from retirement. I was feeling a little twitchy about a month or two ago, and I moved a number of my investments out of equities to something a little more safe. And so my question is, when do I move them back?
Oh, that is the $64,000 question, because everybody says I got out before the big decline. Are they going to ring a bell? Are they going to send me an email? What are they going to do to tell me when to buy back into the market? Don?
Well, One, why did you get twitchy after you heard about coronavirus or before? I'm just curious why you got twitchy. Pardon me?
We've been in a bull market for a very long time.
Okay, so you were just looking. Yeah.
I'm just saying I'm too close to take a huge hit right now.
How do you know that, by the way?
How do I know I'm too close to retirement?
No, how do you know you're too close to take a big hit? In other words, okay, here's just to take a big step back. For everybody, by the way. Your asset allocation, your divide between, the riskier things like stocks, the less risky things like bonds should be about, I think, three things. Number one, you mentioned what? I'm a year and a half from retirement. That's an important thing to know because you have to start accessing some of the money, probably. Mm-hmm. Number two, how your emotions do with all of this, right? And that's why we have the risk quiz that we give out absolutely free to help you. I'd love to see people take the risk quiz before last week and then after last week, by the way.
I know. I think that'd be funny.
But here's the part. Here's the part that you need to know. You need to know what rate of return do you need on your money to sustain yourself over retirement. Then you build it backwards. You say, if I only need to make 5% a year, wow, I'm only going to have half of my money exposed to stocks and half to bonds. You don't look at it dependent on presidential elections, coronavirus, economic meltdown, whatever it is. It has to do with you, not about the market.
We get this process backward, Phyllis. We really do. We're thinking more about our investments and what they might do rather than, as Tom said, what we need them to do and what we can stand them doing on the downside. So it would be a mistake for anybody to say, get back in now, get back in a week from now, get back in 2 months from now. It would be a mistake for anybody to tell you to get in or out at any time until you know those things. How much return do you need your portfolio to generate? Historically, how much risk has that required? Then, how much risk can I stand? Then you get into stocks based on that so that you don't ever do this. You don't ever have to do this again.
And
you
by
don't
the way,
have to guess.
And I would be doing that today. I would be doing that Friday. It would not matter the day to me. In other words, markets up 1,000, down 1,000. I would build the right portfolio based on you, not based on the markets.
Today. Tomorrow.
Right.
Monday.
Wouldn't matter. Does that make sense?
Yes, it does.
Things
for you to think about.
Phyllis.
Yeah, thanks, Phyllis. By the way, the market has been a bit of a roller coaster, right?
That analogy is used a lot.
Yeah, you hear it. You even hear ads of doing the roller coaster. If you're on a roller coaster, how could you hurt yourself on a roller coaster?
Let's see. They're pretty well engineered.
Yeah.
Unless I got on a really bad roller coaster. The only time I've ever heard, and funny story, not funny, sad story. When I was 6 years old, my 6th birthday, at Elitch Gardens in Denver.
Okay.
They had this scary wooden roller coaster.
Yeah.
And a kid, while I was there, got out of his restraint.
You're going to ruin my story.
Stood up.
Oh, no, not going to.
Stood up.
No.
Hit his head on the sign that said, sit down.
I don't want to know
and
anymore.
Died. He died.
Okay, well, now you're making my analogy more serious than it was going to be.
I wanted to make it. This is a serious time.
About as serious as you can get. The only time you can really get hurt on a roller coaster, generally, yes, don't call me if one went off the track. When you try to get off, right?
Before it's done.
Right, okay, yeah. When the ride is concluded, yes, you go ahead and exit to your right, please, because people are getting in from the left. I get that. But
right, okay.
Otherwise, and that's the same as with your money, because just think it through. You get off the wrong day.
Analogy.
Yeah, and Don is being he's mocking me because he knows I stole it.
I'm not mocking you. I
stole it from somebody else, and that's okay. I admit it. I stole it. But the point is, it holds perfectly well. You're hurting yourself by doing this because either you're like Phyllis, I don't know when to get back in, or the market turns and goes up 30%. Your asset allocation is for you, not for the market. Market doesn't care.
Well, and the other thing we all tend to forget, we love the returns the market gives us when it is rising, when it has, after it's been rising. We love those. We want those to go on all the time.
Yeah.
We want that. We want to keep all of that 30% the S&P 500 made last year.
Yeah.
I don't want to give any of that back. No, don't make me give it back. But the reality is, good years and bad years go together. to make those average annual returns that the market has posted over the years in that 9 to 10 to 11% range.
Call us, 855-935-8255. And coming up, we'll also tell you about a class we're going to have next Friday. Try to help you with all of this on Talking Real Money.
Tom and Don are talking real money.
It may not be the sexiest website in the world, but it's your one-stop shop for real money information. TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
That's Tom over there. I'm Don over here. It's your money we're talking about, and it's really important to you. And it's important to us, therefore, because that's what our show's about. So give us a call at 855-935-TALK. During the show, we'll talk to you interactively, or call us anytime and leave your question. We'll do those on the podcast, or sign up for the special class that we're doing online to totally protect you from coronavirus. The whole class will be conducted online on Friday, the 20th of February.
Retirement investing in turbulent times, that kind of ring a bell. So, yeah, Don's going to spend 30, 40, 50 minutes online doing all this, try to help you understand how to build a portfolio interactively. And we only have 100 seats. I think we're already almost 20 seats in. So you're going to want to get one of those that cost nothing. And it's going to be a great session next Friday, the 20th at noon Pacific time.
I have all kinds of great new information to share with you.
That I believe.
One of the things I'm going to share is this that I alluded to earlier. There have been some major events in the United States over the past couple of decades. And you remember, I think it was Thursday where we had the big decline, and it was the biggest decline since 1987.
Yeah, and I can actually still remember that day in the markets.
I was a stockbroker hiding from my clients. My wife,
she was
my
brave
now
enough
wife,
to
was a
answer the
stockbroker.
phones.
She was broker of the day.
That's right.
So she had to get the call.
We'll see. We'll be at the golf course. Good luck. Yeah, no problem.
But the interesting thing, now, if you had a 60-40 portfolio, 60% globally diversified stocks, 40% high-quality bonds, government bonds, by within a year after the stock market crash in 87, your portfolio would have been up 19%.
By the way, that
19%.
one day, this is an important thing because you hear this a lot. The biggest point decline ever, right, was Thursday.
Right.
But it was like 10%. Do you know the percentage in 87? The market went down. It was like 24%.
It was like 20. Yeah, it was huge.
It was huge. So don't
huge.
Get sucked in by improper information. But go ahead, 60-40. Yeah.
Within a year, you were back up 19%. Within 3 years, you were up 33%, and within 5 years, get this, you were up 76%. August 89. Very few people remember this, but that was the savings and loan crisis.
Oh, yeah,
it was
of course.
awful.
Yeah.
Within 1 year, your portfolio was down 2% after that.
Yeah.
3 years up 23. 5 years up 61. Now, we all remember 2001. I'm going to skip some of the others.
I love that movie.
The Asian Contagion. Remember, you don't remember that in 98, do you? The Asian Contagion?
I do remember
we were supposed to all die.
Yeah, I do
We
remember
were supposed to die of that disease, remember? Mm-hmm. Yeah, well, within a year, you were up 16%, 3 years, 25%, 5 years, 52%. But let's go to 2001, the terrorist attack. After 1 year, you were down 1%.
Yeah.
That's all, 1 year. 3 years, you're up 40%. And after 5 years, you were up 81%.
And this brings also to the point that, not unlike what Phyllis just asked us, in my retirement portfolio, how do I decide how to build it? One of the most important things you overlook generally is the right construction of fixed income bonds, right? You need to have the stability in the portfolio. And what have people been doing lately? They've been trying to get into high yield or junk bonds because the other ones aren't making any money. And what's happened to those? Oh, let me see.
Like stocks.
Yeah, they've lost money the last 2 weeks, while the government bonds, DFA's Intermediate Term Government Bond Fund, for example, up over 6% year to date. I'm not saying, and people are doing it, do you know $50 billion have moved out of equity funds over the last 2 months into bonds or cash? Horrible timing. But the point is you should have the right type of fixed income. If you have short and intermediate term U.S. government debt, that has provided a little bit of lift, but a lot of stability, while the stock side has been extremely volatile. So on the right type of bonds, every part of your portfolio does not need to be trying to seek return. This is one of the problems I see with people. Oh, it drives me crazy when people say, I'm in that bond fund.
It's a greed thing more than it is a fear thing.
We'll talk a little bit about greed and fear in just a couple of minutes because you've got a great story about all that. And the hoarding. Please, really, we're going to spend a couple minutes on that too. It drives me crazy.
Yeah, we both have stories about that. You have a story about that. We all have stories about that because we are, talk about greedy. We are a greedy bunch of creatures on this planet. 855-935-TALK is our phone number, 855-935-8255.
Tom and Don are talking real money.
Download the advisor interview form and find out if your advisor's a fiduciary at TalkingRealMoney.com.
Reality radio for a really great future. We're talking real money.
There's less to worry about than you might think.
Is this over yet? Is this going to end soon?
We want to help you. You know, we're really not talking about the virus. We're talking about the reaction to the virus.
Exactly.
What the stock markets are doing, what the bond markets are doing,
the economy is doing.
Investors are doing. The economy is doing.
Shoppers.
What you are doing and what you should be doing. But you mentioned bonds, and you mentioned high-yield bonds before the break.
Did you give the number first?
Oh, I want to do that.
Yeah.
855-935-TALK. Give us a call, 855-935-8255. I'm Don. That's Tom. This is Talking Real Money. I randomly looked up a high-yield bond fund.
Now, high yield, it refers to corporations or municipalities that pay higher interest because the securities they're issuing are considered riskier. They may or may not be able to pay you back.
So I went and looked at Invesco's.
Yeah,
I wanted to get an actively
fund,
managed fund.
Okay.
I wanted to get an actively managed fund, and I decided I want to compare apples to apples, so I got their C-Share, which is their 1%, only 1% front load fund instead of the 5 3/4%.
But what's the expense ratio?
Oh, I was going to save that one for last.
There's a little warm up.
I was going to save that one for last.
Go ahead.
The portfolio is about 92% below investment grade. Junk bonds.
What's the ticker, by the way?
It is AHYCX.
Okay.
Year to date, that fund has lost 11.5%. The yield is only about 3.5%, so it's not that high. That compares with the Vanguard Total World Stock Index loss year-to-date of 19.5%.
Or the Vanguard Total Bond, which is up 2.1.
There you go.
That's what your bond should be doing. Yeah.
And, by the way, you asked about the expense ratio?
Oh, yeah, please. How much? Oh, wait, well, don't tell me. Go ahead. 1% on the front side.
Yeah, don't count that. 1% on the front side.
I'll say 86 basis points.
You would be so off, so far off.
Okay.
So
how far? Just tell us how far.
Add 1%
to
that.
No wonder the yield is so low.
1.92% per year.
How much money is in that fund? That is horrible.
Almost $1 billion.
But the reason people went into that fund is because I want to put money.
It's no load.
Well, yeah, okay, that's good. Thank you for that. No, because I guarantee you the reason that they were moved into it or purchased it on their own is because the yield, the interest. Hey, I'm going to get that bond fund because the interest is much higher than those stupid government bonds you tell me to invest in.
If you bought it at the beginning of the year, your yield was about 3.5%,
so it's not
whereas
that much
governments
higher.
were about 1.5%.
Yeah, right. And look at the price you paid.
Look at what happened.
Yeah.
This is why you can't play games with money, and this is one of the reasons why you need to get rid of your stockbroker. This is the kind of garbage that most stockbrokers, most of the people at the firms that we hate, this is the kind of stuff they sell you. You know, oh, no, there's no load to you. Okay, 1%.
That's nothing compared to 5.7. Yeah. Come on.
And they never tell you what the expense ratio is. No. Never, ever, 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 ever.
And I hate to say it, like finding toilet paper, most of you don't know where to find the expense ratio. I mean, okay, we're going to talk about this right now because you know this is stuck in my craw. I went out today. I'm not a shopper. You know that. Generally,
No, you're not a
I'm not a shopper. I'm like a 10-minute in. I know I get it. So I went to the grocery store this morning at 6:45.
You're a guy. It's hit and get.
I just get out of the way. So anyway, I went in today to look because I was buying a few other things just to see. I wasn't going to buy any toilet paper and hand sanitizer. Guess how much I found at 6:45 in the morning?
Oh, I know how much because I went to a store today.
Zero.
I went. I'm in rural Virginia right now. By the way,
That's true. You are.
I'm in rural Virginia.
They still
I went to
had the
Walmart.
banjos on sale for you, right?
They had lots of those.
Okay.
But
Maybe
the
a harmonica?
toilet paper aisle was a ghost town.
Okay, I'm going to tell you right now, if you're hoarding things like this, shame on you. And here's why. It seems harmless in some ways. No, seriously.
No,
Think it through.
I'm just thinking bad humor.
Okay.
I'm sorry. I'm just thinking bad scatological humor.
If you're someone who only can shop once a week for whatever reason, right? You get the money once a week or your transportation whatever it is. You and I can go to the store every day. I could go there tomorrow at 6:40, and I go every day until I find toilet paper, right, or find a different place. Not everybody gets to live that way. So what you're really doing is harming those people that have transportation issues, money issues, whatever. Stop it. Stop it now. Seriously. You can call me and tell me I'm wrong, but I don't think so.
I think that
we can talk about the hand sanitizer guy who's got a garage full of that, too, if you want as well. Give his address out.
I think we're a little obsessed with our derriere comfort in America. I think that's what it boils down to. I don't see how it could ever be that bad. I really don't.
Don are talking real money.
Just about everything you need to know about money can be found at our website, talkingrealmoney.com.
For your real life and real future, Tom and Don are talking real money.
Can we say it? Don't make an ass of yourself. Quit hoarding? No? Okay. I had come up with a few other ones.
That was really a stretch. 855-935-TALK is our phone number. 855-935-8255.
All right. Sorry.
You could say tush. You can always say
I'm not
tush.
saying anything more. I think you're right.
The Charmin commercials
this
say
could
that.
go straight down. This could go down faster than the Dow Jones.
Hoarding is one thing.
Yeah.
Hoarding is one thing. That's a fear reaction.
Yeah, right.
Okay, and I get it. I don't think it's right, but okay.
But
what's worse is the greed that takes hold with some people in a crisis like this, and it's particularly bad in a health crisis because we have people dying. We honestly have people dying. I mean, on March 1st, the first U.S. death was announced in the Seattle area.
That's only like 2 weeks ago.
2 weeks ago.
Yeah.
2 weeks ago. This is from the New York Times. Two guys that they interviewed, and they gave their names, and they let the New York Times take their pictures.
I saw the pictures. By the way, one man's greed is another man's public service, so go ahead.
Oh, well, let me get to that. The two brothers, Matt and Noah, they went around Chattanooga, Tennessee, going to all the stores and buying up all the hand sanitizer and all the masks.
Yeah, as much as they could, with the idea that they would resell them. Mm-hmm.
They took a 1,300-mile road trip, buying all the hand sanitizer and all the masks everywhere they went, until they had 17,700 bottles of hand sanitizer. I don't know how many masks. They started selling them on Amazon for up to $70 a bottle. They paid $1 for the bottles.
That's what we call greed? Yeah, I think you can call it that. Yeah.
It's horrible. Well, Amazon, the day after they started selling them, kudos to Amazon, shut them down.
Was it only one day they were up there?
One day that they were up there.
Okay.
Now the guys, the two brothers, are furious. They're angry. They're saying this isn't fair. That they honestly said that they felt they were doing a service by reallocating assets from an area where there were plenty of them in the woods where nobody needed them that much to big cities where they needed them. And they said, we're not making that much money because we have to pay to ship the darn things.
Were they going to go? They're going to go into arms sales next or something, helping people with bullets? Or I mean, come on, really?
This is and this is really awful because hospitals can't get the masks.
Right.
Really sick people can't get the masks. These guys have a garage full of them. Oh, storage unit full of them. Now,
do we have the address?
We could certainly find them.
We could.
It would not be hard. We've got their names. They live in Chattanooga, Tennessee.
Yeah, not that big a place.
The state of Washington is considering going after these guys.
Oh. That I didn't know.
Even though they don't have a nexus in Washington,
right?
Their law says that if you sell it to someone in Washington,
now you
violated the consumer protection laws in Washington. So go Washington. Go kick these guys.
That's
and he goes,
sad.
I'm only trying to support my family. Now,
yeah.
I'm okay. He's been doing this for a long time.
Yeah, he's done other things I saw, yeah.
Nike shoes.
Yeah, right. Okay.
And I know a lot of people who've done this with Nike shoes. If you want to take advantage of some idiot who wants to pay too much for a pair of tennis shoes, that's different.
I think Warren Buffett did it with stocks too, right?
Well, yeah, that's different.
He bought things that people were very excited about and then turned around and sold them later for a lot more.
You people who do this are idiots. You are horrible human beings, and I hope that your house is picketed there. I don't want anybody to do anything mean to you, but they should picket your house.
Well, how often do you get to Chattanooga? It's not that far from where you are now, is it?
No, it really isn't. Actually,
you draw a straight line.
I could be in Chattanooga in 3 hours. No, 2.5.
Yeah. Here's your opportunity. What are you doing tomorrow? Here go.
I go ride the Chattanooga choo-choo.
Right straight into town. Yeah, so. that's kind of sad, actually.
And these guys weren't the only one. There were a lot of them.
Yeah.
Do you know what we did though? Because we want to have some hand sanitizer.
Sure.
Around. It's kind of nice. If we buy it, we buy one bottle and it goes away.
Thank you.
But here's what we did the other day. We bought a bottle of aloe gel.
And added in
a bottle of alcohol, isopropyl alcohol.
Yes.
Mix those together.
And guess what?
60-40.
Yeah.
You have hand sanitizer.
I know. You know what I did? Because we were running low at the office. I just went around here at Como. I grabbed 3 bottles, put them in my bag, and there you go. That was easy. Nobody said a thing. Nobody's here. I wandered right in, took the bottles, and there you go.
I'm sorry, but now you are as bad as those guys.
Oh, I wasn't reselling them. I'm using them.
Yeah. I bet Chick-fil-A has the little Purell wipes.
Exactly.
I bet they're wiped out of those Purell wipes too.
It's sad. It's sad. No, but in all seriousness, greed and fear, by the way, it goes right back to where we started the show, because at the end of the day, that's what gets most people in trouble with their investments too, right? Greed because people didn't want to just make 1.5% on their fixed income. I got to make more. Now you're down 12% if you bought that really horrible. I don't know. I think the Vanguard high-yield bond funds lost about 4.5%, so nothing near.
It's a much higher quality bond fund,
and of course,
and its fees and expenses are about 0.2% per year,
versus the 1.8 or whatever. But fear is the other one we mentioned at the top of the program, because that's what drives a lot. That's what has driven people to sell $48 billion worth of stock mutual funds in the last couple of months. You should not be selling those unless it fits your plan to sell them before the market does anything. Otherwise, technically right now you should be selling bond funds and buying stock funds. Not seriously. And does that sound like fun?
How's that going?
Well,
with the clients?
right. We're working on that right now, because we're going to be selling bonds, funds, and buying stock funds. Oh, I'm sure people are going to be thrilled. They did not like it in 2008 either, but it is the right thing to do.
The difference between the kind of investing that we do at our firm and the kind of investing that people do for you at other firms is that we don't pander to clients. We don't give you what you want. We give you what you need. It's like we're more like doctors than the other people in this industry. You know, we're not going to give you a sugar pill and say this is going to make you feel better. Mm-hmm. You know, we're not going to give you medicines that could hurt you in the long term but might make you feel better for a day. We're going to give you the medicine that is necessary to make your future work. And that is one of the biggest reasons why we decided to do this special class. We just decided to do it on Friday. We're doing it next Friday online. So you don't have to worry about going out in public, exposing yourself to any germs, unless there are e-germs, and I have not heard of those yet.
No, I think you're okay.
There are internet viruses, but you can't really catch those and get sick. We are doing a class on this kind of a market and how you should react today. If you haven't done it already, and our applause, kudos to all of you who have in the past built that portfolio that allows you to sleep at night when the markets do this. And we know there are lots and lots of you.
By the way, out of the 800 client families we work for, I think it's 2 that have done something.
Yeah.
Yeah. I mean, we tell you this is part of the process.
We
it has to
guarantee
be.
this.
You have to.
This is the only thing we guarantee. We guarantee we're going to have a bad market.
You have to bear the uncertainty of stocks to get the returns. That's why it has paid more over time. Really.
If you want safe,
right,
you have to accept no return. Literally, after inflation and taxes, no return, but you're safe.
So before we run out of time, how did they go to talkingrealmoney.com?
Right, just click on events.
Yep, it's free.
Sign up for the class.
Yeah, it'll be worth it. Worth every nickel.
Friday at noon Pacific, we'll get together on Zoom. You have to sign up for a free Zoom account. It's
very
free.
easy. Even I did it on my computer.
Easy.
I mean,
you did it all by yourself?
I didn't need any help.
All by yourself?
This is a big day for me. I know.
Wow, I'm pretty impressed. So go do that. Go sign up for that because it'll put your mind at ease. It'll help others. You'll know what to do from here on in, all that kind of stuff. All right? And give us a call at 855-935-TALK, 855-935-8255, 24/7.
Tom and Don are talking real money.
Would you like to talk to a real investment advisor for free? Set up an appointment at talkingrealmoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Once again, the markets are giving you an opportunity to get your financial life right. If you haven't done it yet, learn how you're supposed to build a portfolio for retirement based on your ability and need to take risk. That's why we're doing a brief class, interactive class. Only 100 seats are available. It's called Retirement Investing in Turbulent Times. It's on Friday the 20th, noon Pacific time. Sign up now at talkingrealmoney.com. Click on events, talkingrealmoney.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Astray, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. That should keep the lawyers happy.